Good morning, everyone. Thanks for joining us today for the John Lewis Partnerships half-year results presentation. We're joined by members of the executive team. There'll be a short presentation, and then we'll have plenty of time for your questions. Joining us today, we have Nish Kankawala, who's a Partnership Chief Executive. We have Andy Mounsey, who's our Interim Finance Director. We have James Bailey from Waitrose and Peter Ruiz from John Lewis. And I'll hand over to Nish.
Thanks very much, Chris, and good morning, everybody, and thanks for joining us today. It's my second year as CEO, and I'm proud to announce another improved set of results for the partnership, delivered by our amazing, hard-working partners that I really want to thank. You'll have seen from our announcement this morning that the partnership has considerably improved financial performance year on year, reducing losses in the first half by 91%, whilst continuing to invest heavily in our future growth. These results show our transformation plan is working and on track. We completed the first phase of our multi-year transformation by returning to profit at the last full year, and we expect a significant uplift in profits for this full year. As you'll recall, we refreshed our partnership plan last year to focus unashamedly on retail, to deliver a long-term, sustainable platform for achieving our purpose, unleashing the potential of our much-loved brands, John Lewis and Waitrose, supported by our absolutely amazing partners. And we've made significant progress so far this year and remain on target through our consistent focus on the same four key drivers. So let me just remind you of those four drivers. Energizing our customer offer to drive growth, delivering inspired service by our amazing partners, modernizing our retail infrastructure, and driving significant investment fueled by productivity and strong cash flow. For Waitrose, we're building on our passion for great tasting food, quality and ethical standards, whilst enhancing even further our service delivery for our customers. For John Lewis, we're building on our strength as an omni-channel retailer, differentiating on product design and curation, quality, service, and price. James and Peter will share more in a few minutes. While our relentless focus on investing to improve our retail brands, we continue to make good progress in growing our financial service business, and we're progressing planning permissions for our lead build-to-rent sites. So, the plan is working. We're delivering good momentum across all key customer and financial metrics with an upward trajectory in profitability, customer numbers, and cash generation, as you can see from this chart. We remain confident there's still much more to do with tremendous potential for our partnership. So, let me focus on the first half and our strategic priorities. You can see we're making strong and consistent progress. So let me give you the key highlights, and the team will elaborate further. So, sales of 5.9 billion with growth of 2% and a 91% improvement in profitability, prioritizing significant investment in half one to ensure an impactful half two. Liquidity at 1.7 billion, and we've generated more cash, 97 million pounds more year on year to invest record amounts in our growth. We're in strong shape and have a solid foundation from which to accelerate our transformation. We continue to invest in both brands in quality, differentiated service and value, and customers are responding, with 500,000 more shopping with us during the first half of this year, and customer satisfaction and loyalty both increasing in both brands. We're also increasing the time our partners spend with customers in both brands by simplifying our shop process, and this is critical. And finally, we're investing a record £160 million in partner pay this year and have accelerated our training and capability plans for our partners. We're investing significantly in our store estate. In Waitrose, we're investing £1 billion in opening 100 new convenience stores over the next 5 years, and we're also investing in the refurbishment of 150 existing stores, which is almost half the estate. In John Lewis, We're completing a large-scale refurbishment of our flagship Oxford Street store and modernising High Wycombe and Cheadle stores in the second half, with more to follow. Across the business, our tech modernisation is being aided by the £100 million partnership we signed with Google. This is helping us build a stronger foundation for our transformation. So from migrating our data centre to the cloud, to greater AI capabilities supporting customer propositions, such as the delivery of Never Knowingly Undersold in John Lewis and our recipe innovations in Waitrose. We're continuing to simplify our work, enhancing customer service and reducing costs. We achieved a further £78 million of productivity savings in the half and on target to hit the £900 million by 2026 that I highlighted at the full year. We're also investing over £2.4 billion over the next 4 years, with nearly £500 million this year. That's an increase of 53% compared to last year. So significant investment in half one has given us a great foundation for half two, where, as you know, most of our business is done. The team will now share more detail on the financials and highlights within the brands. So let me first hand over to Handy.
Thanks very much, Nish, and good morning, everybody. I'm pleased to report significantly improved financial results in the first half. We've improved all our financial metrics, delivering improved profitability, improved productivity, and improved cash generation. I'll now just take a few moments to unpack the key elements of how we've done that. In the first half, the partnership made a loss before tax and exceptional costs of £5 million. That's an improvement of £52 million on the same period last year, driven by a combination of sales growth, margin rate growth, and improved productivity across the business. Partnership sales were £5.9 billion, up 2% from a year earlier, with Waitrose up 5%, driven by both price and volume, and JL down 3% in the context of a challenging general merchandise market. We delivered gross margin rate improvement of 80 basis points, with John Lewis up 46 basis points and Waitrose up 117 basis points. JL margins were up due to lower markdowns as we look to utilise our promotional investments more efficiently and lower freight costs. In Waitrose, margins were up as we worked with suppliers hand in hand to reduce cost of ingredients across a number of product ranges without compromising on quality. We also delivered savings across our goods not for resale and through leveraging technology investments, multi-year technology investments, which have improved availability for our customers and reduced wastage. Within the margin rate performance is the impact of a further £39 million of investment in new lower prices this half. We continue to feel the effects of inflation across our operating costs, increasing costs by £64 million this year, albeit significantly down on the heights of last year. Wage growth from our record pay investment announced earlier this year, combined with inflation across the rest of our operating costs, most notably property and supply chain, were largely offset by the ongoing improvements to the productivity of our business. And that was delivered principally through better matching of partner hours to customer need in Waitrose shops, the rollout of technology to support efficiency, such as automation in the JL supply chain and the rollout of headsets in John Lewis branches, alongside savings we've made in central teams as we simplify work, and continuing to tightly control spend on goods not for resale, such as technology, property, and supply chain costs. In total, £78 million worth of efficiency savings were delivered in the half, taking the total since the beginning of the plan launch in January 2021 to £500 million of savings, on track, as Nish mentioned, to reach £900 million by 2026. Our productivity plan is ensuring we're delivering an improved profitability in a way that's not only better for the business, but better for customers. For example, in Waitrose, availability is up at record levels following tech investments, which is a great outcome for both our customers and the business. And our focus on ensuring we have partners available when customers want them and need them most are delivering improved customer satisfaction scores in both brands. Losses before tax, once we factor in exceptional costs, were £30 million in the first half, an improvement of £29 million on last year. We incurred £25 million worth of exceptional costs in the first half, very much as expected as we progress through our multi-year transformation plan. These costs relate to the ongoing simplification of the business. The progress of our transformation is clear when you look at the operating margins on the right-hand side of the page you can see in front of you. We've grown the business efficiently through improved gross margin rate and productivity across the cost base. Consequently, operating profit margins have increased by 120 basis points or 1.2 percentage points year on year, meaning more of our sales are converting to profit both now and as we look ahead. This gives us real confidence in the strength of our profit conversion as we head into the all-important second half. You can move me on one. Stronger profit performance combined with good control over our working capital delivered improved cash generation, up £97 million year on year to reach £147 million. This contributes towards a strong liquidity position of £1.7 billion at the half, up £348 million on last year. As a reminder, our total liquidity figures at the half comprised of £420 million of unused credit facility and £1.3 billion of cash and short-term deposits. Our total liquidity position is strong, meaning that we expect to continue to self-fund high levels of investment in the partnership over the coming years. In the first half, we've invested £186 million into the business. Approximately two-thirds of that money went on a combination of maintaining and refreshing our shop estate, our supply chain assets, and fixing some of the basics we know are critical to our customers' experience and our partners' working environment, combined with improving customer experiences in shops and online and developing our newer businesses. The remaining third was invested in productivity changes that will continue to deliver improved results for years to come. We expect to invest around £500 million over the full year. That's up 53% year on year. And over the second half, we'll continue to invest in refreshing our shop and propositions, simplifying how we work, and leveraging the technology investments we are making to improve customer experience. As mentioned at the year end, we plan to repay our £300 million bond during January 2025 from cash reserves, which will take our external borrowings to the lowest level in over 20 years. So in summary, we've delivered significant improvement in profitability and productivity of the business this year so far, and we expect more to come over the second half. Improved cash generation and prudent management of the balance sheet over a number of years means we have the funds to deliver our transformation and continue to fuel the partnership's growth. So I'm now going to hand over to James to talk more about Waitrose performance.
Thanks, Andy, and morning, everyone. James from Waitrose here. So I'm really pleased to tell you that Waitrose has had a very strong first half. Our sales grew by around 5%, with inflation easing and volume and mix responding positively. And as a result, as you can see from the Kantar data, we're growing market share. We've now had 10 consecutive quarters of customer growth, which means nearly 2 million more people shop with us now than did just 2 years ago. And all of our growth is like for like from existing stores and online. We haven't opened a new shop in over 6 years now, which means we're driving trading intensities at the same time as becoming significantly more efficient in our operations. And as a result, operating margins have improved very significantly year on year. In the half, we've taken the first steps in our plans to invest £1 billion renewing our shop estate. The latest example at John Barnes, Finchley Road, launched only a couple of weeks ago and is performing well ahead of expectations. We've also announced that we plan to open 100 new little Waitrose stores and confirmed that the first new store will be open in the next couple of months at Hampton Hill in southwest London. We've landed a series of major product and sourcing innovations through the half, including our collaboration with great brands like Ottolenghi and Zoe, our purchase of the premium meal delivery business Dishpatch, and our first in-house Gales bakery. And we've also accelerated our own brand product innovation, launching hundreds more new products in the last 6 months compared to the same period last year. At the same time, we've continued to invest in price with a further 40 million invested in the first half and more to come in the second. In May, with the launch of Farming for Nature, we became the first supermarket in the UK to take a stand on behalf of our customers and farmers by committing to convert our supply chain to regenerative farming. And if you care at all about the future of food and the planet, we mustn't be the last. I'm really pleased to say we've also seen very significant improvements in our customer satisfaction. Our more efficient and flexible store operations have enabled us to have more partners in store when our customers need them most. We were proud to win the Grocer 33 Award for Service for the 4th year in a row and to come 4th out of 250 companies in the most recent Institute for Customer Services survey. We were the highest rated supermarket in the UK. And lastly, as mentioned, we're seeing sustained and significant improvement in our underlying profitability. Operating margins have improved very significantly year on year as we start to realise the benefits of the hard work done to make our operations more and more efficient. As a result of that hard work, we're on course for one of the most profitable years for Waitrose for a decade. We still have a long list of projects which we're confident will continue this profit improvement and, importantly, provide the extra fuel for continued growth. So in conclusion, as I said, Waitrose has had a very strong half. We take a lot of momentum and confidence into the second half, and looking ahead, we have a pipeline of very exciting plans which I think will delight our customers and accelerate our growth. And with that, I'll hand you over to Peter.
Thank you, James. Sales in the first half for John Lewis were 2 billion, down 3% in a very challenging market, but level with the IMRG and just behind the BRC. We delivered record beauty sales at plus 7% year on year, with makeup, fragrance and new brands driving the growth. In home, there were highlights from Cookshop at plus 7% year on year, Haberdashery at plus 5%, and year on year growth for home accessories at plus 0.5%. However, the squeeze on customers' disposable income did hit sales on big ticket items. On technology, sales of larger electricals and TVs were similarly impacted. However, personal tech, such as smart wearables, were standout, and mobile phones were plus 25% better due to improved availability, AI innovation, and our strong guarantees, convenience, and financing proposition. The fashion market has been tough, not helped by unseasonal weather, but we did see our strongest ever season for lingerie, and year-on-year growth of plus 3% for jewellery and plus 7% on children's brands. We achieved record H1 sales for nursery at plus 1% on the year, with our highest ever bookings of all things baby advice appointments. Adjusted operating profit declined by 24 million, in line with our expectations, as we invested for future growth and maintained competitiveness on price. In response, customer numbers grew again to 13.6 million, with net promoter score and overall customer satisfaction both improving. As I mentioned, we made a deliberate choice to invest for the second half and the future to drive growth, productivity, and enhance customer experience. Last week, we announced the return of Never Knowingly Undersold, reimagined for how customers shop today, offering great quality, service, and prices in store and online, and restarting the conversation as to what it means to live knowingly in the 21st century. And I can say that the launch has been exceptional. We are forging new partnerships and attracting exciting brands. Waterstones is set to open in John Lewis Oxford Street in October, and we've announced collaborations with Collagerie and the premium fashion brand Awake Mode. Trinity London is launching this month and in 8 stores, and we have an exclusive partnership for the Aura Ring. We are making significant improvements to our physical estate with 3 new beauty halls, including the creation of one of the UK's largest at Oxford Street, including new brands such as Loewe and Skin & Me. We have an innovative new store computing format and exciting new concepts in large electrical and jewellery, with future brand updates across all our stores. We are investing in our omnichannel proposition with new capabilities such as Ship from Store, which will transform our shop estate into an additional fulfilment centre for web and app orders. And we are reinvesting in our D2C platform, introducing ClearPay to our ways to pay, and now have over 16,000 collection points for click and collect orders. This is all underpinned by a continued focus on customer service, with more partners in customer-facing roles, supported by additional service training, improved use of technology such as headsets, and coming soon, the ability to take payment on mobile partner devices. I'll now hand back to Nish.
Thanks, Peter. And before we open up for questions, let me just conclude. So it's been another half of strong progress as we deliver on our multi-year transformation plan, and we're certainly on track to build on that progress in the second half. We continue to deliver sustainable growth with material improvement in our performance and underlying financial health, with significant cash generation, which is powering our investment. As we look ahead, our top priority remains our valued customers and supporting our amazing partners. In the coming months, they will have the opportunity to see the acceleration in our investment program, which includes the refurbishment of stores in both brands and new locations for Waitrose stores. I feel confident in our plans for the second half. We have bold new season and Christmas propositions coming, planned for our customers. And I'm most proud to demonstrate that the transformation around brilliant retail is working. And thanks to the hard work and commitment of our partners, we remain on track to significantly uplift profits at the full year. Together, we're building an exciting future for our partnership, which is a unique business, the largest employee-owned business in the UK and one of the biggest in the world. It's the model that will power our continued recovery. Thank you all for listening to our presentation, and I'll hand back over to Chris to field any key questions.
Thank you, Nish. If you do have any questions and you're on the screen, please do raise your hand. If you're joining us on the phone, if you can press *9, then we can take your question. First up, we have John Ryan. Hi, John. Thanks for joining us. If you can go ahead and unmute and ask your question. John, I think you just need to.
Right, can you hear me now?
Yeah, we can now.
Yeah.
Great. Hi, John.
Good. Hello. Thanks so much for taking my question. Peter, on Waterstones and John Lewis, you mentioned that in passing just now. What sort of space are you going to give to that in Oxford Street? And is this the first of a few, or is it very much a trial?
It's definitely the start of a few, and we are pushing into Oxford Street first as our flagship store and a big opportunity for Waterstones. I need to come back to you on the precise space, but it's significant, and it'll be a proper flagship for Waterstones on Oxford Street. It's not going to be a small little sort of shop-in-shop.
Yeah.
So I'm just looking at a note here. We think it's going to be about 20,000 square feet. No books.
Oh, it is big. Yeah. Which floor is it going to be on?
Oh, sorry. It's going to be on the second floor next to Benugo.
Okay. Yeah. Thanks.
Thanks very much, John. I think we've announced today that we're going to have nearly 20,000 books in the space, so it is going to be a significant space. Next up, we have a question on the phone, and it's the phone number ending 536. So if you just press *6 to unmute yourself, you'll be able to ask your question. So if you just press *6, you should be able to unmute yourself and ask the question.
Hi, good morning. Can you hear me?
Yeah, we can. Hi there.
Hello, good morning. Sridhar Mamkali from UBS. Well, thank you for taking my question. Really couple on Waitrose, both, please. Firstly, I mean, helpfully you've given us some pricing information in the first half, about 2%. What do you think inflation is doing into second half as you look at it? And secondly, there's quite interesting margin drivers in the first half you talked through. If you could talk a little bit more around how did that come about, 120 basis points in gross margin, and any thoughts in terms of how we should look at rest of the year? Clearly, you've talked about this year, one of the most profitable years in about a decade for Waitrose. So if you could just explain the gross margin point, that would be very helpful. Thank you.
Thanks for your question. Andy, do you want to start on that one, actually?
Yeah, so great question. Thanks very much, and good to talk today. So let me pick up on the margin point that you just asked about there. So you're right, 117 basis point growth in Waitrose margins over the first half. That was a combination of items, as you would expect. One of the things we've been doing is investing in multi-year technology to improve availability across our Waitrose shops over the coming years, and we're now at record levels of availability. As a byproduct of that, what we're seeing is a reduced level of wastage, which is feeding into the Waitrose margin numbers. In addition, we've also seen some really strong growth in on-demand grocery, which James might want to talk a little bit more about in a moment, which again has been a really helpful driver of margin growth in the Waitrose business. And then I would say the third thing is, as part of our multi-year transformation activity and as part of our ongoing £900 million target for productivity, we've been working very much hand in hand with a number of suppliers to really work at end-to-end reductions in supply chain costs, which means lower pricing in terms of some of the input costs for Waitrose, but that's been very much working hand in hand without compromising, of course, on any quality. So it's a combination of things that have been driving that margin number, and we continue to see those improvements, expectations flowing through in the coming years as well.
Hi, it's James here. Just on your question on grocery inflation, we've seen it relatively stable through the first half, so starting around 3 and finishing nearer just below 2. It's been relatively stable now for at least 3 months, and there's nothing in the future forecasts and certainly in the market that makes us think that will change, particularly over the course of the next 6 to 12 months. So a steady, around about 2% inflation is what we're expecting.
Thanks,
you both. Very helpful.
Thank you very much for your question. Next up, we have Neil Keeney. Neil, just want to say where you're from, and you should be able to speak now.
Yeah, hi guys, good morning. Neil Keeney from JP Morgan. Question on cap allocation, please. Appreciate the consistency of the message around the investment program and on the plans to redeem the Jan 25 bond with cash. Going forward, as regards bond market financing, should we consider this to be a sort of definitive move away from that? Should we consider this to be a temporary move, and once the business is back on a, I suppose, sure operational footing, you may look to tap bond markets again? And apropos of that, is there any plans to seek a bond rating from any of the credit rating agencies?
Andy, do you want to take that one?
Yeah, thanks very much for the question. So what you've heard from us today is really strong improvements in cash generation off the back of both sales growth, margin growth, and the efficiencies. Now, what that's allowing us to do is to invest high levels of investment in the partnership over the coming years, very much self-financed. As you picked up, we do expect to repay the bond in Jan 25 off the back of strong levels of cash reserves that we're sitting on at the half year. We never rule anything out in terms of future financing. Clearly, that's a decision for another day in the future, but that's not something we are concerned with in the short term at this point.
Thank you, Andy. Neil, does that answer your question?
Yeah, that's good. Yeah, that's good for me. Thank you very much.
And that concludes all the questions we have today. Oh, sorry. Yes, that concludes the questions we have today. Nish, final words from you?
Yeah, thank you, everybody, for dialing in this morning, and thank you for the really good questions. I mean, I just want to conclude by saying that our transformation plan is very much on track. And, you know, our customers tell us, as do our partners, that the buzz is back at John Lewis. And I really do believe we are now starting that turnaround, and I feel very confident about the second half of the year and our delivery of our transformation plan. So thank you, everybody, for dialing in today.
Thank you, Nish. And thanks for joining us on the call. If you do have any follow-up questions, please do get in touch with the team.